Welcome to Lesson 4, Part 4, Borrowing and Fees. In this lesson, we will cover how to use credit to your advantage and the different fees attached to various credit options. Credit cards, the rules. How much credit should you use? Financial institutions will tell you to borrow no more than 20% of your yearly net income. So let's figure out what this all means and if it's good advice. We're going to start by understanding the difference between gross and net. Gross is the total amount you earn before any deductions, such as taxes and expenses. Net is the actual amount of your paycheck after those deductions, which are the taxes and expenses. For example, gross income will be the total of the $15 per hour that you make. Net income will be what you get after the deduction, such as program fees, mandatory savings, extra savings, child support, etc. Let's do a little exercise to better understand. As I stated before, the banks will tell you to never borrow more than 20% of your yearly net income. Say you're making $15 an hour, working 35 hours a week. Your gross income will be $25,000 per year. But $180 is deducted for program fees, mandatory savings, etc. How much are you actually making each week with this deduction? I'd say about $345. Now, how much would you be making each month with this deduction? That would come out to $1,380. What about in a year? This would come out to $16,560. So if you're making $16,560 per year, how much should you borrow? Here's the math. 20%, as stated, is the most that the financial institutions suggest you borrow, or 0.20 times the $16,000 per year. That would come out to $3,312. Now, $3,312 seems like a lot of money to pay back if you're making $25,000 as your gross and $16,650 net per year. But what if your credit has a 25% interest rate? You will then owe $3,312 times 25% or 0.25, which comes out to $828 in interest alone. So if we take $3,312 plus the $828, that equals to $4,140 that you will need to pay back within a year. If we break that down, $4,140, you will be making payments of $345 for a total of 12 months. This could also mean that 1 week out of every month's income goes right to paying off the interest on that card alone. In addition to APR, here are some other ways that financial institutions can end up as additional charges to the balance of your bill, which in turn you will have to pay interest on. These fees will often, but not always, allow the credit card company to increase your APR. Late payment fee, balance transfer fee, cash advance fee. These are added each time and higher than your card's APR and annual fee. Late payment fees. If you make a payment after your due date or make less than the minimum payment, you will be charged a late fee. Some credit card companies may have tiered late fees based on your credit card balance. Here are some examples. If your balance is between $0 and $500, your late fee may be $15. If your balance is over $500, your late fee may be $30. Other credit card companies have fixed late fees regardless of the balance on your credit card. By law, credit card companies are limited to what they can charge for late fees. Credit card companies can charge a maximum late fee of $25 for the first time you're late, and up to $35 for every late payment within a 6-month period. Late fees can't exceed the amount of the violation. For example, if you were late on a $10 payment, then the late fee cannot be higher than $10. Because of this, many credit card companies have made the minimum payment of $25 or more. You may want to look into this prior to applying. Balance transfer fees. A balance transfer fee is a one-time fee you pay when transferring a balance from one credit card to a different credit card. Since the balance transfer fee is added to the balance when it's moved to the new card, you can pay it over time as you pay off the balance you've transferred. Now you might ask, how much can I get charged for this? At a minimum, the balance transfer fee is 3% of the amount transferred, with a $5 to $10 minimum. At maximum, there is no cap on the amount of the balance transfer fee credit card companies charge, so your fee could be more than $100 if you're transferring a big balance. When is it worth it? Consider taking advantage of a promotional balance transfer offer with a new credit card. Many offer between 6 and 18 months of interest-free options, which can potentially save you hundreds of dollars and allow you to pay a larger portion of your credit card debt. However, after the interest-free term ends, the interest rate will go back to its original rate. It's important to keep this in mind so there are no surprises. This is generally worth doing so if you are able to pay off most or all of the balance before the promotional period ends, or if the balance transfer fee is lower than the amount of the interest that you would have paid on the current credit card. Cash advance fees. Taking out a cash advance on a credit card is almost like withdrawing cash from the ATM. However, you're actually borrowing from your own credit limit. This process works exactly like paying your credit card bill by repaying the amount used. Think back to our credit card calculation with Sam, who took a cash advance fee. He needed to pay a one-time fee, which is the cash advance fee, in addition to the regular APR interest. Most credit card companies charge either a flat fee or a percentage of the cash advance amount, basically whichever is greater. Here's an example. Let's say a term on a cash advance fee is $10 or 5%. If you take out a cash advance on $100, under these terms, your cash advance fee would be $10, since 5% of $100 is only $5. Another example using this term would be if you take a cash advance of $500, your cash advance fee would be $25. Remember, the credit card company will charge whichever is greater. Annual fees. An annual fee is what you will be charged once a year for having the credit card. Unlike APR interest, this fee stays the same no matter how much or little you may use the card. Now you might ask, how much can it cost? Well, annual fees range anywhere from $30 to $500, depending on the credit card you choose. Higher annual fees are charged on credit cards for those with bad credit, as well as premium credit cards for those with excellent credit. An annual fee is not always a bad thing. Here's an example. Many reward cards and premium cards offer perks that exceed the annual fee. Those who have trouble getting approved for other credit cards may have to choose a card with an annual fee until they qualify for a better credit card. Child support and credit. Your standing with the OCSE, Office of Child Support Enforcement, can and will affect your credit. Your name may be submitted to credit bureaus when the following items occur. If your child support account is more than 2 months past due, or the past due amount is over $1,000. In order to avoid these negative marks, you will have to reduce the past due amount to less than $1,000, or less than the amount to be paid for 2 months, or claim mistake of fact within 10 days. In some cases, there has been difficulty in obtaining loans and or other forms of credit until the overdue child support obligation is paid. These issues can also prevent you from moving forward with housing opportunities. Make sure that your current child support order is one of your primary bills each month. OCSE provides options for payment plans to better help non-custodial parents in making their payments. You can speak with your instructor to get more information on this if you're interested. To get credit for completing this part, please return back to the Google Classroom tab and click where it says Classwork. Make sure to complete Lesson 4, Part 4 Assessment, Borrowing and Fees Google Form, and mark as done.